Thanks, Dave. Thanks for calling in.
All right, buddy. Have a good one.
Okay, thanks. All right, and it's nice to hear from Dave again. Steve?
I'm here.
Okay. You know, while we're talking about automated systems, we've got about a minute and a half before the next break. Is it possible for you and I to talk about automated systems for a little bit?
Of course.
Okay, because I want to get into some of the macro stuff, but, you know, you've been involved with a lot of systems, algorithms, things like that. I mean, your trading in general really relies not off of hunches, and, you know, it requires a very systematic approach. Give me the elevator pitch on algorithms and systems in your book. What would you say are the main pressure points from the good side and the bad side when it comes to systems?
I mean, obviously, people have written countless books about that. So the elevator pitch, I don't know that is really that even exists. But
I'm just kidding. Your thoughts.
I think the most important thing is that you pick your right volatility environment, because if you start trading in a market which is just range constrained and has no volatility, you start generating signals which really don't carry you anywhere. You don't go anywhere in your position, and you don't generate any profits. And just because the market just always goes the other way, when there's no trend development, you get churned away and you start losing money. So I think the volatility environment, the right volatility environment where you trade, is really the most important thing.
Right.
And that is true for any market. I mean, for currencies, I'm not talking about stocks, but if the market just is range bound, doesn't go anywhere, any trend following system will fail, and the only thing which is going to make money are counter trend systems. It's very difficult to differentiate between the two of them at any given moment in time.
True. Hey, Steve, can you hang out? We got to go to break and want to cover some stuff with you. Okay, cool. Guys, we'll be right back.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
If you're looking to discover a new financial resource and diversify your financial portfolio, consider the new Market Safe Focused Commodity CD from Everbank. This 5-year U.S. dollar-denominated CD gives you exposure to 6 equally weighted commodities, including gold, silver, copper, nickel, soybeans, and sugar, in one powerful CD. With annual pricing caps of 50% per component, you could earn up to a 50% upside payment at maturity if the commodities increase in value across annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on this index CD. Don't miss out. Take advantage of this financial resource designed to grow with the times. The October 13th funding deadline will be here before you know it. So hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This advertisement is sponsored content. Everbank is a member FDIC.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged Leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. We've got Steve Benger on with us this morning. Steve, you were kind of talking about some volatility consideration, I guess, when you're kind of thinking about algorithms and when and if to even trigger something. You want to keep expounding on that, or?
Sure. Yeah.
Okay.
I mean,
Okay.
What I said before is that a trend-following signal will typically not work in a low volatility environment. That is unless an uptrend has been very well established and you just kind of like swim within that trend. But what usually happens in a very low volatility environment is that the ratio of potential win versus potential loss starts to come in. So in other words, if you have a decent volatility environment, your win-loss ratio in terms of like monetary value on the trade might be 2-to-1 or 3-to-1, which everybody's hoping for, right? Your winners should be 2 or 3 times larger than your losers. But in a low volatility environment, that is not going to work because the market will not carry the trade far enough.
Right.
So that is
Sometimes
something
it's just
which I
not
think-
worth putting a trade on.
Yeah,
from
thank
that
you.
standpoint.
Yes, that's well put. Yes, John.
Yeah,
Exactly.
and you.
I couldn't have said it any better.
One of the things too, like I'm just going to use. I'm showing the Japanese yen right now, and I'm showing. You know, I looked at the weekly here. We've covered this a zillion times in the morning here, but that big number down below 133.34 on the yen. But one of the things you just spoke of, I mean, a lot of times, we'll look at these 240s to kind of regulate things. And right now, the boxes or the profiles themselves have really tightened up on this thing. So, and the reason I'm saying that, it kind of pairs a little bit with what you just said. Trading the so-called volatility inside the profile might not be worth it. And we've talked about this a lot. In fact, Dave and I in particular talked about this a lot of times. We talked about this, the algorithms. A lot of times when it gets to a certain point of this kind of contraction and volatility and the profiles kind of pinch in, if you will, we're not looking to trade inside the box anymore. We're waiting for a possible breakout because, again, it's not worth it to really spend the time, energy, the money, and the low risk reward scenarios that are really presented by trading inside this kind of low volatility place. So when it does break out of, these kind of inflection points that a lot of things are geared around, we're passing on the ricochet stuff inside and waiting for like a much better high probability situation that breaks out of the scene. So, it goes directly in line with what you were talking about. So, yeah, I mean, you want to talk macro for a little bit?
Sure.
Yeah, I was sitting there thinking last night, what does Fox really want to happen here? I mean, like the network. I was thinking, okay, I don't know if Hannity's hoping for Trump to get elected because then he's going to have to defend him, and then would he be hoping that Hillary wins just because he's got more material to kind of constantly slam her with? You know what I mean? Like, this is just the crazy times, and I don't know, what really, what anybody's really hoping for in the network scene, because they want material and they want to be able to kind of, do their thing. And, and then, how does Trump's, kind of appearance and temperament or whatever in the latest debate? I mean, how's that going to affect the markets? Obviously, the markets won't par for the course. But, how much of let's just say he does the next debate's October 8th. How much impact do you think would affect the markets if Trump actually he goes through some Clockwork Orange type mechanism where they kind of upset him, and every time he gets upset, this is in training, that they kind of shock him or whatever, and maybe he kind of stays in somewhat a little bit better control next time, and maybe he edges up in the polls. What do you think is going to happen to the markets?
I just love it when you put so many things into one question.
I know. Yeah, it's an hour-long show.
Yeah, because what happens to the market because of politics might be different, in my opinion, than what is going to happen to the market anyhow. So let's talk about the political ramifications first.
Okay.
Obviously the market went up yesterday, and the reaction was positive, undoubtedly, because Clinton seemed to have done better in the post-debate analysis than Trump. So the market seems to like a Clinton candidacy or a Clinton presidency better than Trump. And that, I think, is a playbook for the next debate, right? If Clinton does well, the market is up, and there should be a post-debate bounce. How long it's going to last, that then leads into the second part of your loaded question, and that is, what is market going to do in general?
Right.
Right?
Yeah, we had a lot of pieces to that question. Yeah.
Yes.
So, with the global slowdown, I guess Yellen kind of sitting on the back burner as far as whether they're ever going to raise rates, and looking for any reason to seemingly not raise rates. Do you think that could carry through, that attitude? Could just kind of low rate environment, no economy really is on fire right now. Do you think the low rate situation could still carry this thing north, and maybe like the Hillary kind of relief thing, that maybe she starts taking control of the polls? And do you think that's enough, low rate environment coupled with Hillary kind of being in the lead, maybe? Do you think that's enough to really kind of move this thing north, or what do you think about that?
That's really the question, obviously.
Yep.
So if you look at the market and how the market is reacting to interest rate gyrations, and I don't know if you can put up an S&P chart here, but we had this fairly big...
I got it up right now.
Yeah, so we had this fairly big break about, 2.5 weeks ago, where the market really sold off and made new highs. Volatility went north of 25, and that was a pretty sizable move within the low range environment we are in. And then the Fed went to that quiet period whereby they aren't allowed to make any policy discussions 1 week prior to a Fed meeting, and the market stabilized. Yellen came out, and we got this 2-day rally in the stock market. And since then, we have been trending down for another 2 days, up until yesterday, when we got that post-debate bounce after Clinton. So the long and the short of all of that is that at the end of the day, interest rates are driving this market. I really believe that. And
I think that's fair to say.
Yeah, and the fear of rising interest rates is what is going to suppress the market between now and early November. Because two things are happening early November. We have the next FOMC meeting, November 1-2, and the election November 8th. Until then, I don't think it's going to happen.
Can you stay on, or can you stay on after this? Okay, great. Guys, we'll be right back with Steve Benger.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Sorry, guys, my mic was muted. Thanks for joining us again. Steve Benger's on with us. And Steve, can I show this chart you just sent me?
Yes, please.
Okay, let me put this over here. And sorry, guys, my mic was muted there. Okay, what are we looking at here, if you can see it?
Yeah, so basically, just because we are talking about the volatility environment and the response to the Fed meeting, this is a 2-year chart of volatility, and the white bars on the bottom show the percentage change of volatility on a daily basis. And if you go back to the right of the chart, we have this one big outlier, kind of like the last big outlier. And that was a response to some Fed speak before the Fed meeting. So there was about 2.5 weeks ago when the market sold off. And as you can see, in volatility terms, that was a really big move. I mean, it's basically the third biggest move we have had in volatility in the past 2 years. Yeah, right there. Okay. So it's a really big move in volatility. And I think it's kind of like history repeats itself. We're going to see something similar potentially running into the next Fed meeting and the election, which are both early November.
Okay. I've got a question for you. Somebody was kind of just, this is a thought to ponder here. If somebody's holding October VIX options, maybe it might be a strangle or a straddle. Would it be appropriate to roll them to December? What are your thoughts on, like, we talked about, hey, this thing's going to get a little wild here soon again. But what are your thoughts on kind of rolling things out and just kind of staying the course?
So I think you're going to have one big volatility event between here and early November. It's kind of like the repeat of what we had 2 weeks ago. So October is not going to cut it.
Okay.
I think you want to be in, January calls, perhaps December, but really January, I think. January or even March is the next month, I think would be a much better bet.
Now, some of the things that you spoke of before, which were just dead on, about, just kind of buckling yourself into a volatility play because it had contracted so much. A lot of those plays kind of did what they were supposed to do, and volatility exploded. Yeah, go ahead.
Yeah, I think I've only said twice on your show to buy volatility, right? The last time that pretty much hit the volatility event we just discussed right on the head.
Right. So it's just
the other one was actually even better than that, quite honestly.
So the reason, October relative to December, January that we're talking about right now might not be any massive impacting events going to happen anytime super soon, but at some point, it's just a waiting game, and where do you kind of hide and wait? And you're saying that, okay, go ahead.
Yeah, so if you look at the price of volatility, I think we might be going down to 12 on the VIX index, and anytime we see a 12 or 11 print, I think you are in a pretty good position to accumulate some volatility calls. And I think it's going to happen between now and perhaps the next 2 weeks, and perhaps as early as today, who knows, but because we're very close.
Right. No, we are. And, they kind of let the air out of this after the debate, too. And, markets don't seem very disturbed about anything right now. I kind of got that out of the way type scenario. Is there any strategy other than just keeping it simple and, buying?
Yeah, the other thing, which is what I like to call, I don't want to say conservative, but which I think is very viable, is that once volatility drops below 12, you start writing puts on volatility.
Gotcha.
Because volatility, unlike any other market, has a natural bottom. Volatility in its entire life has never traded below 980, I believe. 980 was the lowest number we ever recorded.
Right,
so
I think
for volatility,
Basil pointed that out one day for me because I was thinking it was actually lower, but yeah, I think that is the low print.
Yeah. So volatility, there's kind of like a natural bottom in volatility. So once volatility gets towards that low end of the range, selling puts in volatilities is a fairly safe bet. You have to kind of watch out for what's being called the roll yield, because the VXX contract naturally loses ground, but you have to size it correctly. And then I think it's a fairly low risk, high reward setup.
Yeah. So let me ask you this. Considering that, volatility never seems to, unless we're way up there in the stratosphere, never seems to really spike down super hard, especially at these levels that we're speaking about, the 980 being the low print there. But is there enough down there to warrant the risk selling those puts? And is there a way to even do a credit spread on those puts? Is it even worth it to try to or is there enough kind of play wiggle room there to get out of those things if you're wrong, or what's the story there?
Well, you can always do a ratio spread, whereby you buy at the money volatility puts and sell out of the money, and the out of the money pay for your at the money. And then because the VXX has what's being called a negative roll yield, as of right now, that contract's going to lose about 8% per month. If I haven't looked lately, but it's about 8% per month. So your in-the-money puts should actually start making you money, and the out-of-the-money puts should expire worthless. So in combination of those two things, it's I consider that to be a very, very good trade.
Is there any reasons to think, like, just based on what you just said about, October versus December, January, is there any reasons to think about a calendar spread on something like this at all? Like selling?
Yeah, I mean, I actually think that one of the trades I use to actually be long volatility and not really have the premium expense is I actually buy out of the money calls, December, January calls, and sell closer to the I sell out of the money calls in a closer months.
Right. I like
the
that.
Credit out of the shorter duration calls pay for the decay out of the money calls, and the ratio to be used is about 2-to-1. So my ratio of shorter duration calls versus longer duration calls is 1-to-2. And
So if it gets away with you, it kind of like also covers, you make
more money on the upside.
Okay.
But in the meantime, when it churns away, you're not going to lose money on the decay out of the long calls.
That seems like a relatively decent situation to get into, especially considering what we just spoke of. Yeah.
Yes, it is.
That's awesome.
I would agree that is a pretty good trade.
Awesome. Well, listen, Steve, thanks for coming on today, and thanks for that insight. We're going to go to our last segment here in just a bit, but appreciate your time this morning, and always good to talk to you, my friend.
The honor was all mine.
We'll catch you later. Guys, we'll be right back.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi guys, welcome back to the show. It was awesome to have Dave on earlier, asking about the signals that we spent just ungodly amounts of time on. And Steve Benger, of course, always a pleasure to have him on. Got beans up again here. I've been pretty bearish on beans. We kind of got that little flush yesterday, but the reversal is concerning on a short-term basis. Still think these are headed down long-term, but again, this kind of reversal coming back into that 945 area. We've reached the low this morning, 946. We might get a little bit of a contra, a little bounce here, so keep an eye on that one. This is all indicated in the scanner. It will show bottom on the daily there on beans, and your upside targets on this one would be 64 if you're going to do that long trade. But again, I think you're trading against the long-term trend down here. This is kind of the macro step back and get out of the noise weeds and kind of understand what's happening here. So 964 is really still that major situation on beans. Crude, we talked about, this is, I think, just stay away from it right now. I think you're going to get chopped up. The S&Ps, breath got a little positive here, 2149, 2150. Now it's going to be a supportive situation here on the S&Ps. Got some bad news out of the way. The VIX is kind of crunched in a little bit. Steve's was pointing that out. When we get into these areas, a lot of times it's really, really difficult to step back and really kind of be patient and wait for these things to happen that are the great long-term setups. And what he was speaking of is, hey, when the VIX is floating around 17, 16, all that, when we get down into the 12s of the world on that particular trade, then you've got a historic, decent little situation to look at. And also combined with a little bit of a timing situation on the October, and JB asked some really good questions on that. Maybe that calendar ratio spread's appropriate here because you might not want to miss the boat, but also you might have a time frame here that you could scoop up some points in the meantime to cover, the cost of that impending explosion that may happen, I guess. So great information this morning, and good questions from Dave earlier. Let's take a look at the XLF here because this thing was kind of sitting right at support yesterday, and I was keeping my eye on it. Here's the weekly. I'm not terribly excited about being long the banks or the financials in general right now, but again, you can kind of see what's happened recently, but that 1905, a little bit of support situation there, but these banks are not going to want to hear about problems in the banking industry, possibly new regulations, and also a narrowing yield curve that just never seems to go away. So again, Yellen and her crew are day trading the latest stats, slanted towards, God, I hope we don't have to ever do anything. That's just the attitude they have, and nobody wants to stop the party of low rates and the market's possibility of loving those low rates. So that's kind of where it stands, and rates and politics is kind of where it's happening right now, and Hillary's kind of the ease of mind side of the equation on that, and market's kind of told everybody that that's the way it's looking at it. Guys, you've been great. Keep the questions coming on a daily basis. Those are great. Everybody can learn from them, and even JB mentioned something in the den about that particular strategy and the VIX in those different months. I think everybody can get some use out of questions like that when we try to answer them. Guys, you've been great. Stay tuned for Larry. You'll thoroughly enjoy it.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman wave sequence. Using the Chapman wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.